Applying what you've learned so far is not that hard since this system is really simple, but there are some forces which might hold you back and prevent you from achieving the financial freedom you deserve. The psychological factors I've outlined in the previous video surely make up one of the hurdles you must jump over, but the desire to time the stock purchases and sales perfectly can have the same paralyzing effect until you watch this video and give yourself some time to think about the message it conveys. In fact, this is the topic I receive the most questions about. My students and the readers of my Hungarian book are the living proof that market timing deserves special attention. Look at this chart showing the S&P 500 index between 1994 and the March of 2016. Honestly, wouldn't it be great to always buy stocks at the bottom, sell out on the top, and repeat this infinitely? This is what perfect timing means, and although it sounds good, it is totally impossible in practice. I'm not expecting you to believe me, but look at what some super investors with outstanding success and credibility think about timing the market. Reading these quotes, you can notice that even the financial media admits the hard fact, although they are interested in selling you the papers full of predictions. The good news is that your inability to see the turning points in the stock market is not your shortcoming. Experience shows that even the so-called experts are as bad at market timing as you are. If anyone had this special ability, he would surely be a billionaire, but as Peter Lynch says, a successful market timer has yet to appear on Forbes' list of the richest people. I hope this slide has an impact on your thinking, but here comes something even more powerful. Charles Schwab conducted a research on the performance of 5 hypothetical long-term investors. Each of them received $2,000 at the beginning of every year for 20 years, ending in 2012. And they invested the money in the market, represented by the S&P 500 index. The first investor, called Perfect Peter, had the incredible luck to place his $2,000 into the market every year at the lowest monthly close. His timing was perfect. The second investor was not this lucky. He invested the money as soon as he got it and did this consistently for 20 years. The third investor chose a dollar cost averaging approach, so he divided his annual $2,000 into 12 equal portions, which he invested at the beginning of each month. We also have a bad timer who bought at the market peak in every single year, and the last investor who kept on waiting for lower stock prices and invested in treasury bills only. The results are really telling. Just look at the ending wealth figures shown on the chart. What this means for you is if you keep building your dividend portfolio and contribute to it every year, you do not need to time the market at all. It is impossible, it would drain you emotionally, while it is not that rewarding as you might have thought. You should either put your money to work in undervalued top quality dividend payers as soon as you get it, or if you get a significant lump sum payment, the dollar cost averaging approach may deserve your attention. Both of these solutions take psychology out of the game and they can help you overcome procrastination. And to make the results even more credible, Schwab analyzed 68 rolling 20-year periods dating back to 1926 and came to the same conclusion. I highly encourage you to read the short article about this research and put your money to work as soon as you can after carefully selecting your investment targets. Leave the game of market timing to the losers, since no serious long-term investor should be involved in it. So your takeaway is this. Accept that no indicator can predict market movements. The Shiller PE, for example, can tell you something about where the market valuation stands in historical perspective, but even if it shows overvaluation, it cannot accurately predict the next downturn. Accept what Keynes, the English economist, said, that the markets can stay irrational longer than you can stay solvent. As no one can predict the market movements, the best you can do is to continuously scan the market for top quality stocks available at fair or lower prices. As your experience grows, you will notice that the number of potential targets you find is not independent from the level of market valuation, but you only need to focus on your shortlist and let the speculators do the fortune telling. If you identified an opportunity, have the cash to invest, and that particular stock is not overweight in your portfolio, then buy it. After all, what would you wait for? A quality stock at a fair price for the long term is the perfect combination. However, if you already own all the stocks on your shortlist and wouldn't like to add to any of the positions, then you can wait for other opportunities to come up. Understand that time is your friend if you invest in top quality companies. They raise their dividends regularly and finance their growth from the reinvested free cash flow. Let compounding work for you, which is the eighth wonder of the world, as Einstein put it. Remember that time in the market is more important than timing the market. Being a spectator makes no sense at all, and it can delay achieving your financial freedom. Remember that in Schwab's research, the procrastinator who invested in treasuries only came in last place, way behind the hypothetical worst market timer. I encourage you to buy the stocks on your shortlist as soon as you can. This is the most important takeaway here, backed by super investors and Schwab's convincing research.